Hello, ladies and gentlemen. Good morning, good afternoon, and good evening, everybody. Welcome here to this live Google Hangout. This is going to be on the Forex trend trading plan, and I'm very thankful to have you here with us today. We're going to be talking about some of the great trends that are taking place in the FX market, but more importantly, how do you identify those trades? How do you trade those trades? And then how do you manage your open positions? So we've got a lot of great material to go over today, in addition to talking about some of the wonderful trends that are out in this market. Now, before we move any further, I do need to take a moment. I will need to take a moment and share with you this risk disclaimer before we move any further. So if you can take a moment and read this, and we will get started and introduce who we've got here on the horn with us. Now, this first screen simply says that what I'm about to show you is no guarantee that we are going to find winning trades. And what I'm about to show you, and Walker and I, what we're about to show you is no guarantee that you will be kept away from losing trades. Therefore, it is important that you trade with risk-based capital. Risk-based capital is money that you can afford to lose. Also, some of the trends and some of the potential trading ideas or opportunities that we're talking about today doesn't necessarily mean that these are advice to you, that we are suggesting that you make these exact trades. Of course, you need to consider your own investing style and situation before making any live trades. All right. So here we go now. Let me get that risk disclaimer off the screen. Now, joining me here today is going to be Mr. Walker England. Mr. Walker England has been a trading instructor here at Daily FX for several years, probably. Well, you've been with us for about, what, 7 years now, Walker?
Jeremy, it's actually been closer to 8, but let me say it's been an absolute pleasure. And again, it's a pleasure to be here speaking on behalf of FXCM and dailyfx.com. And today we're going to be approaching trending markets. Now, trending markets, one of those things that you may have heard about but not quite had a plan of action for trading. And when you leave here today, that's exactly what I want you to leave here with, an understanding of a 3-step trend trading plan.
Awesome, Walker. Appreciate that. Now, you'll notice we'll go ahead and get the room set up, and then we'll let Walker take the helm and get us started on talking on how we can identify these trends. Now, I see, Kim, you've already found your way into the room, and that you have found the Q&A box. For everybody else, there's a Q&A box. That's an opportunity for you to be able to ask us your questions. We will be going along and taking as many questions that we have time for. We certainly encourage you to go ahead and pop those questions into that Q&A box. Secondly, you'll also notice on this page, if you like what you've seen here, if you like what's
Can you
going
pull it
on,
just a little bit closer?
we would encourage you to go ahead and do a +1, and that will let us know that you like this content. We'll look to do more of it, and any additional topics that is of interest to you as well. Okay, so let's go ahead and get started. As Walker suggested, we're going to talk about identifying the trend first off. So Walker, when it goes out to when you're out looking for a strong trend to trade, what are some of the things that you do to identify the strongest trend out there to make sure that you're in a strong trend? What are some of the techniques that you look for?
Well, one of the keys that I look for is certainly going to be the price action itself. And when we denote a trend, whether it's going to be an uptrend or a downtrend, the market should have a specific direction. And this is a classic look at an uptrend. What we have here is the Swiss yen chart. And what we can find is we had a low all the way back here in September, actually July of 2012. Now that low was right in the neighborhood of 78.35. Now, we can glance at the chart, we can see price going up with hindsight, but one of the steps I like to take with my graphs, whether it's going to be a daily, a 1 hour, a 2 hour, or anything in between, is just take a simple stroll and walk from left to right on my graph. Now, what I'm doing is identifying a swing high and a swing low. And if you're unfamiliar with trends, hey, that's okay. We're all here to learn. Let me go ahead and really qualify what a swing high is. A swing high is going to be these peaks in price. It should look kind of like a mountain where you see it stick out above price. And what we'll do is once we see price start to retrace and move off of that high, we're going to mark it with a line using Market Scope 2.0. Now again, we see the market hardly ever heading in a straight direction all of the time. When price goes ahead and makes a valley, this is what's going to be a swing low. And that swing low going to help us identify at least a temporary market bottom. And again, you'll see all of these V-shaped patterns start to emerge in the market as price moves from swing low to swing high. Now, when it comes to an uptrend, and the Swiss yen certainly qualifies in that category, I want to make sure that my highs are continually advancing. And what that means to me as a trader is that price is continuing moving up towards a higher high completing our uptrend. That's exactly where we stand in regards to price. So first rule, when it comes to finding the trend, I say, hey, just go ahead, take everything off of your charts, use price action and see if the swing highs are getting higher. And if we see the swing lows advancing as well up our chart, odds are we have ourselves in an uptrend. Have any great suggestions to add to that, Jeremy?
Now, you're right on the money. Let me go ahead and share my chart with you here as well. Just try to keep it simple when it comes to trend trading. Trend trading is one of the oldest types of trading strategies out there. And so there's no need to overthink this. Walker, as you know, I've got 3 small children at home, and many times when I'm spending more time on the computer and in front of the charts than I am with my children, sometimes my daughter will come in and sit on my lap and want to, she'll want to make a trade. But in reality, what it is, she wants to spend time with me. And so I'll take it a moment. I'll try to teach her some simple things. And trend trading is the first thing that I go after. Basically, just take a look at your chart, Malin, and what direction are prices generally moving. Is it generally moving up? Is it generally moving down? Here the euro dollar, we've been in a bit of an uptrend. And if we take a look at other pairs as well, the pound CAD is one of interest for me here lately. Obviously, a very clear uptrend. These are the types of trends that we want to go after. And the more distance you have from top to bottom, from bottom to top, the better.
All right. I appreciate the insight there, Jeremy. Now, once people have a bearing on how to find an uptrend, I think it's wise to go ahead and help find the alternative scenario, and that's going to be the downtrend. And truth be told, if we can find one, we can identify the other. The practices are just going to be inverse. So what I mean by that is we'll still identify our swing highs and swing lows and work from left to right on our graph. But what we'll see now as price heads down is our swing lows should continue to get lower. And that means those V-shaped pieces of price should continue to dip down before we see what's known as a retracement. Price moves back up, makes a new swing high, before moving down to a lower low. Now this is an Aussie Kiwi chart on the daily. This is considered one of our cross pairs here, but it is in a staggering downtrend, and it goes all the way back from November of last year, running just a little over a year long now, and we can see consistently price retracing and then breaking down towards lower lows. And truth be told, what we see when price is going down, that's really going to be our opportunity to trade with momentum and the market. And stay tuned, that's going to be the second portion of our conversation as we start to look at entries. All right, that's going to be our downtrend there. Jeremy, you have any tricks for identifying a downtrend?
No, not much different than what we've already talked about. I do want to throw it out to the audience. I know we've got several folks in the room. We've got Kim and Sash. Karen's out there as well as Viv. What are some trends that you all are seeing out there Perhaps we can take a look at these in real time as well. Go ahead and type those into the Q&A box, and once we've got once we've got a couple of these trends in force that we've got our eyeball set on, Walker. I know there's a couple of different ways that we can enter them. For you, you like to look at retracements. So how about do you set up a trade once you've seen a strong trend?
Well, I think retracements is going to be those natural ways for traders to approach the market. And let's be honest, it's just human nature to want to buy low and sell high. And that's exactly what retracements aspire to do. And remember these dips that we had back down to our swing lows. Now, hypothetically, again, let's go back and think about how wonderful it would be to enter into the trend at these key areas. Well, again, we can look back on our graph and see, hey, that'd be absolutely wonderful as this trend continues up towards higher highs. Now, the tricky part is, how do we identify these areas on the graph? Certainly going back and saying, oh, this would be a great spot to buy, but identifying them is a completely different manner. And one of the ways I like to simplify the process is by using a technical oscillator. Now, if you're uninitiated in regards to technical indicators, don't sweat it. We're going to cover the basics here, but make sure that certainly you do your due diligence before going out and trading with a technical indicator. And today I'm going to start with CCI. This is known as the Commodity Channel Index, and this was developed back in the 80s to, hey, find exactly what it was named for, commodity channels. Well, one thing certain, even on the daily chart, we'll find that this oscillator is built to track the previous highs and lows and find dips and valleys in the market. And what I want you to see is just take a look at CCI. You'll see that it has peaks and valleys much like price. And these peaks and valleys going to denote overbought and oversold levels. Let me show you exactly what I mean here. First, this indicator is going to be divided into two halves by a center line, and that center line going to be right in the middle here. And any oscillator that you trade for that matter, again, one of these indicators that is tracking price moving up and down is going to have a center line, and that's going to be reference of 0, which is right in the middle of my oscillator. From here, what I'm really interested are going to be these values above and below. You'll notice that up above, going to be 100, our top line, this is considered overbought. Now, overbought, going to be important because you'll notice that means that price is now making a relative extreme to the upside. And if we're trading a strong trend like the Swiss yen, which is moving up towards higher highs, this is absolutely something that we want to pay attention to because we want price to be going overbought. That means price is pushing in the direction of the trend. However, if price is pushing towards higher highs, that doesn't mean that we're buying low and selling highs. So when we're trading retracements, we actually want to wait for a pullback. And remember, we had our bottom line here, and we denoted these areas already with a buy. But looking to buy, you'll see our pullback in price. Our indicator, CCI, again, the Commodity Channel Index, pulls back below 100, or excuse me, negative 100. Negative 100, that is showing that price is moving to an oversold region. Now, oversold, again, just by reference, is meaning that price is making a relative low. That's a good thing if we're retracements because we want to buy at a better price. We don't want to buy at the peak. We want to buy on a pullback to buy low and attempt to exit our trade as it makes a higher high. Now, we can see the oversold variables. Again, we have multiple crossovers on this trend. Now, crossovers just showing us when momentum is returning back in the direction of that trending location. And with CCI, that means I want to go ahead and look for an area where CCI moves back above this oversold value in an uptrend. And we can see here on the daily chart, momentum came back into the market right here on November the 9th when we had that line close back above negative 100. That would have been our first opportunity to buy. So That's going to be CCI using an oscillator in an uptrend. Again, waiting patiently and only executing once we see a return from that oversold value. What are your thoughts, Jeremy?
So Walker, when you were talking about the CCI and it gets broken into two halves, I thought you were going to say it was the haves and the have-nots. So, but I'm curious, Walker, why the CCI? I mean, there's many other tools or oscillators you could have chosen. Why did you go after the CCI here?
CCI is just a personal preference, Jeremy. I want you to know that you can choose from any of the different oscillators here on MarketScope 2.0. Personally, I've become comfortable with CCI just due to the nature of its calculations. It tends to move a little bit quicker. And truth be told, some oscillators will be slower and some oscillators will be quicker. Now, there's a little give and take. If you get into the trade earlier, that means that, hey, you may be exposing yourself to being the first one in line to get stopped out on a particular trade. Conversely, however, if you're using a quick oscillator like CCI, that means you can help maximize your profits by getting into the market first. So it's a give and take. Again, you can be the first to be wrong, but you can also be the first one into the trade. And here's another oscillator. This is going to be MACD. I'm going to put them side by side to show you exactly what I'm talking about. Traditionally, MACD, you look for crossovers as well. You look for a red crossover of our signal line. Now, if you're unfamiliar with MACD, that's okay. I just want you to look at how far away our entry was. And it was 1, 2, 3 days, count it out, until we had the crossover on MACD. Now, does that mean that MACD is better than CCI? Not necessarily. Both have their strengths, both have their weaknesses, and as long as we're aware of them, we can use them to our advantage to timing trades with the trend.
So Walker, RT also has a question here about the RSI, using RSI to time it. What are your thoughts on the RSI as an oscillator? I know you mentioned, they all do about the same thing. Some are just faster than others. Some are slower than the others. Your preference was CCI, which I actually think is a pretty good choice because it is quicker in the way that it calculates. And you got to think, if you do a good job at picking a strong trend, that means that if it's an uptrend, that means when it dips, it's probably not going to dip for very long. So you are going to want something that probably is a little more responsive. And CCI definitely does the honors for that. But if you don't mind just commenting about RSI and maybe throwing it on the scale of oscillators as to how fast or how slow it might be compared to MACD or CCI rather.
Absolutely. Thank you for the question. And I took the liberty of going ahead and pulling up RSI while we were asking the question here. Notice how many crossovers we had with CCI beforehand. We labeled a few of them. Well, going all the way back, there has only been 2 crossovers for the better part of, wow, nearly, what is that, 2 years of price action on the Swiss yen. So we can go ahead and trade with RSI, but you need to be aware that it may take quite a while, at least on the daily chart, to identify these overbought and oversold areas. So again, it's a give or take. RSI may keep you out of some potential losing trades, but in the interim, where there's no signals, you miss out on the winners as well. So truth be told, you can execute with both. And looking at this chart, we did see some great signals in the past for both CCI and RSI. Just a matter of practicing with both, identifying which works best for you, and really contributes the amount of signals that you're looking for in your trading plan.
Awesome. Walker, would you mind commenting about, you're looking at a daily chart there, looking at the trend, using the RSI to time some entries on that daily chart. What are your thoughts about dialing into a smaller time frame chart and using the RSI signals on that smaller time frame chart to time your entries?
No, I think that's an excellent idea, Jeremy. And what you can do is use the same proceedings to identify trading opportunities. Now, here is the Swiss yen. Again, same chart, same graph, but now we've really dialed in on price action. And what you'll find is this is a 30-minute chart. A lot more interesting, right? We get a shorter-term look on price action, and truth be told, when I teach my scalping classes inside of Daily FX Plus, this is exactly the chart and the time frame that I like to begin on. Now, again, remember on the daily chart, we had 2 signals in a year. Now, looking at RSI in the 30-minute graph, over the course of the last 3 trading weeks, we had 1, 2, and now 3 opportunities to enter in with the trend. And just walking down the chart, doing a little bit of manual back testing, these appear to have been quite profitable if you were watching RSI on the 30-minute graph. Now, does that mean it will work every time? No, the trend will eventually come to an end. But still, I think the proof is in the pudding that we can use these oscillators on virtually any time frame. We just have to know their pluses and their cons and trade, knowing their strengths and weaknesses. Now, Jeremy, I know you have a specific methodology you like to approach when trading the trend. Why don't you tell us a little bit about breakouts?
Yeah, absolutely. As a matter of fact, Kim is reading my mind. Great minds think alike there, Kim. On this swing low, could we use a small time frame and use a break of that line to buy instead of the oscillator? And that's, Kim, basically how I do a lot of my trades. Not all of them, but I may look for a zone of retracement. So what Walker was talking about was a retracement. So we're in a strong uptrend, and I'll use the dollar yen here as an example. This is a daily chart. Over the last 2 months, we've been in a strong uptrend, and you'll notice there's small retracements as we move along during this uptrend. And so you could use those retracements to time entries into the trades. And so there's 2 different types of breakouts that I will look for. So I'm going to focus in on this area right here. Okay. I'm going to focus in on this green area and go into a smaller time frame chart. And this does require looking at a smaller time frame chart before you actually enter into the trade. So here's my green circled area, and so you'll notice that prices were trading higher, started to meander sideways a little bit, and so what I'll do is I'll look for some type of resistance line. Because the trend is up, I'm going to look for some type of resistance to get broken. It could be horizontal resistance, it could be a trend line resistance like this black line is here. And then you'll notice that prices conform to this very nicely. And then this area right here, let me get rid of the green circle. Actually, let me make this green circle smaller. This area right here would have gotten me really interested in this trade. And what makes me interested in this area right here is notice that as we were retracing lower, prices came back and tested this trend line. It pushed lower, but this low was not as low as the previous low. So right here is a little bit of a clue that prices are starting to garner up some more energy and possibly make its push higher. And so sure enough, it came back, retested again. 2 hours later, made another low that was higher than this low. This is a this is a warning that it's gathering up the energy in order to break through this resistance, and then sure enough, boom, it did. So we would just simply place an order to buy up above this black resistance line, place your stop loss just below the swing low. So I like using intraday time frames for using trend line breaks if once prices have reached a potential reversal zone that that I've suggested or that I'm considering. The other way to do it, Walker, is just simple horizontal levels of support and resistance. And for that, I'm going to add the Donchian channels to my charts. And the Donchian channels, in my opinion, are one of the, let me go back here to this area, one of the least utilized tools in a trader's toolbox. A lot of people do not know about the Donchian channels, and I think they should. It is incredibly simple to use and incredibly powerful. I've over the years I've done some testing, some programming of various strategies, and I've tried them on the MACD, stochastics, RSI, CCI, the MICKEY. No matter what it is, I've tried coding it, and I've got to admit, ladies and gentlemen, when it comes to a trend following strategy, those trend following strategies that incorporate some type of a breakout of the Donchian channels on about a minimum of a 1 hour time frame. or higher, 1 hour, 2 hour, 4 hour daily. Strategies that incorporate the Donchian channels, especially when you have a strong trend, generally works out well. And basically what you do is you look at this brown line, which is the upper Donchian channel, and since our trend is up, we just simply look for a break up above the upper channel. And for this, I like to do straight price of 1 pip above the upper channel. I know some folks would look for a candle to close, but for me, it's 1 pip. And it does a couple of things for me. One is I don't have to sit and constantly go look at my charts every 4 hours or every 2 hours or every hour, depending on the time frame of my chart. I just set the entry orders out there, and either they trigger or they don't. So it's easy to manage in that regard. That's what I like. The second thing is what you get in confirmation, you lose in price. So if I wait for a candle to confirm closing up above my upper Donchian channel, well, I may end up giving up 10, 20, 30 pips and waiting for that confirmation. I'd much rather have those 10, 20, 30 pips back and just know that prices, the market is indicating to me that it's ready to break out to new highs. So Beth, and seeing your question here about using the Donchian channels, like I said, I think Donchian channels, absolutely love them, and I think they are one of the most underutilized tools in a trader's toolbox because they're very simple to follow. I've done some testing using Donchian channels in the past, and when you incorporate the Donchian channels with a strong trend, things tend to work out in your favor. Not always. You'll have some losing trades, but it can keep you out of some losing trades as well, because notice here, notice that let's say I place my order to buy above this upper Donchian channel right here, and let's assume that prices never make it up to there and prices end up reversing lower. Well, I would have been kept out of a losing trade because my idea was to buy, and prices ended up going lower. And so Donchian channels or some type of breakout strategy can keep you out of some losing trades. But what you get with that is you are waiting for additional confirmation for prices to trade at a higher high than where they were before. Whereas if you're using a retracement method that Walker was talking about, you're entering at a better price, but you're giving up on some of that confirmation. And so therefore you may enter into some losing trades, like if you're going through a much deeper retracement. So Walker, once you're in some of these live trades, how do you go about managing them?
What I want to do is just propose a question to you very quickly. On your chart with the Donchian channels, I see between, what is that, the 14th or the 15th, multiple touches of the top boundary of our graph. Now, does that mean I have to buy every time we have a breakout, or would you set one order and then move on to the next position, or what would you do with multiple touches of the top of that line on your JPY chart?
Yeah, good question, Walker. In the effort of keeping things simple, what you want to do is, and I'm looking at a 2-hour time frame chart. So it's an intraday chart, whether it's 1 hour, 2 hour. The Donchian channel is set to 55 input value. And basically, ideally, the best entry is going to be on that first touch, 1 pip above the upper channel in an uptrend here. Okay, so right here is ideally the first entry. Now let's say that I missed the first entry. I was away from my charts, or I got sick that day. I couldn't watch the charts. I didn't have my order set up. And this is what I'm looking at when I finally do open up that dollar-yen chart. Well, yeah, I missed the best entry. That would have been down here near the 99.40 level. But what I'm going to do is I'm going to use the upper Donchian channel from the point I open up the chart. So right now, my entry is going to be looking around that 99.80 area. And then eventually prices do break up above a day or two later. And so then that's where I would enter into the trade, place my stop loss down here near the low. And then once I'm entered into the trade, all I have to do is just log into my charts, see where my lower channel is, and then adjust my stop loss according to the lower channel. And if you're using the desktop charts, very simple, you just left click and drag the order. So it's very easy to manage. It will take you longer to log into and out of the charts than it will be to manage the trades, which is one of the reasons why I love it. But in this area where you get multiple pokes up above, if you're not in the trade, then you can go ahead and use those as entries into the trade. If you're looking for multiple entries into a trade, I don't. I usually do one and done. If you're using multiple entries, you could use this as a method of getting in multiple trades at a time. But for me, I would much rather want to take on different positions than have multiple trades in the same currency pair, if that makes any sense. So I want to have a spread and a diversification across the various currency pairs I'm trading rather than load up 5 different trades on my dollar yen.
All right, I appreciate the honest answer there, Jeremy. I know sometimes as traders we get really excited about the entries, and all of a sudden we've been waiting, our oscillator turns over, and we start seeing breakouts, and we just want to take every trade possible. But certainly we want a technical trigger, but we need to consider the third part of any strategy, and that is going to be managing risk. And you absolutely alluded to this, but I want to make sure everybody watching the video knows that first, we can lose money when it comes to trading, and second, we need to be aware of how much we have at risk when we go ahead and put our order out there into the market. So we're going to take a few examples here, and I want to go ahead and flip back to my Swiss yen chart. Now, first, for those of you that aren't aware, a order to close us out of the market at a predetermined price, or specifically a loss, it's going to be a stop order. And that is STOP. Those are big letters. Certainly, we don't want to get stopped out, but if we do, we want to have an area where we feel comfortable exiting the market. Now, what I like specifically about walking down my charts is it gives me a clear level where to put my stops. Remember, the definition of an uptrend is the continuation of price forming higher highs, and also we should be seeing my lows advance as well. Now, on this particular position, again, this is one that we discussed in full inside of the Daily FX Plus Classroom. We were looking at the previous swing low in price, and what we have here is just an extension of that line, and if I measure from low to high, you'll notice that that is going to be just about 250 pips in risk. Now consider this. Price goes ahead and turns down and starts making a lower low. Again, this is an area where I want to exit the graph as quickly as possible. And I'll tell you, I will be the first to take my order off the table in the event that I'm wrong. Even though this trend has been going on for multiple months at a time, there's going to be periods that, hey, there may be a reversal or even a bigger retracement. So I want to make sure that I'm preserving my trading capital for a later time. The easiest way to do that, again, just go ahead and set your stops underneath that previous swing low, and depending on how risk adverse you are, the further you can put it away in regards to price and previous highs and lows. But just remember, we do have to go ahead and consider risk reward and ratio to our stop losses. Jeremy, you want to go ahead and talk about risk reward ratios a little bit?
Yeah, absolutely. In my endeavors on programming strategies, so several years ago, I think it was 2009, I was testing out, because there's a lot of strategies, a lot of programs where it will talk about your entry. So Walker and I have been talking about the entry, how you get into trades. And I thought, you know what, let me see if I can test a way to see how exits do. And in an effort to do so, my whole idea was I would create a strategy, a programmable strategy that randomly enters the market, and then based on different money management techniques, it would exit the market. And what I found out is that those with better risk-reward ratios, positive risk-reward ratios, meaning where you were, on average, expected to gain more pips when you win than what you lost. That's a positive risk-reward ratio. Positive risk-reward ratios generally did better on an average basis over this time period. I think it was like a 2-year period on the euro dollar. And again, it was buying on Monday and then managing the trade. selling on Tuesday and then managing the trade. So it didn't matter what the news events were, whatever the trades were at that time. And the reason that it worked out is because if we're in a strong trend like what we're looking at here on the dollar yen, if I'm buying on Monday, well, the chance of me winning is going to be pretty good. And so I'm winning twice as many or 3 times as many pips as when I lose. And then if I come back and if I sell on Tuesday, well, I'm selling against the uptrend. So the chances are I'm probably going to get stopped out. And so I'm going to lose a small portion. But then when Wednesday comes rolling around and I'm buying again according to this random strategy, I call it the monkey strategy, well, the chances are I'm going to win because I'm trading in the direction of the trend. And so when you're trend trading, you definitely need to go for a minimum of a 1-to-2 risk-reward ratio. For every pip that you're risking, look for at least 2 pips of reward. And then that way, if you're buying in a situation where you're doing a little bit of a counter trend retracement like what we see here, yeah, you might lose on the first trade. You might even lose on the second trade. But when you come back and you're doing a 1-to-2 or 1-to-3 risk-reward ratio, if you're able to win on 50% of your trades, do the math, you will be doing well over the long run. So it's important to have at least a 1-to-2, sometimes even a 1-to-3 risk-reward ratio on your trades. So Walker, do you have a target? Do you use 1-to-2, 1-to-3? I mean, how do you establish where to go after your risk-reward ratio?
Excellent question, Jeremy. And what I have here is just a small green box and a small red box. It doesn't look like much at first, but this is actually quantifying the risk-reward ratio that we have for this trade. Now, in our webinar, we designed this to be a 1-to-4. And what that means for me as a trader is I am risking 250 pips, again, using risk, to make at least 1,000 or more in profit. And where that puts us is right at the top of our green box, right here in the neighborhood of 117.60. And essentially, if we go ahead and pick that up, we've gone ahead and confirmed our uptrend. First, because we made a higher high. Second, because my profit target is up above, I want to make sure that that's where I exit the market. Now, where do you set risk rewards? You start at 1-to-2. Do you set it at 1-to-3, 1-to-4, or 1-to-5? I think it comes down to how long you expect to be in this trade. Now, this trade, again, it has been on for the better part of a month. And again, not every trader has that same time horizon. And what I see is the shorter time periods tend to lean more towards shorter risk-reward ratios. Again, the moves are smaller. However, we can still make sure that we're making more profit when we're right relative to when we are wrong. This one, again, if we just compare our profit target to our stop loss, you'll see that's a 1-to-4 risk-reward ratio. And what's nice about that, that means I can be 20% accurate, meaning 1-to-5 out of every trade's being correct or a winner to be break-even, if not net profitable on my account. So where do you start? It all starts with time duration. And remember, like Jeremy said, the larger your reward relative to your risk, the less often you have to be correct in market direction.
Yeah, Walker, you said something that I agree with wholeheartedly, that your risk-reward ratio is going to depend upon your time horizon, that the shorter risk-reward ratio are going to be on smaller time frame charts. And that was one thing that I found out through this monkey strategy, was I just used an arbitrary 50 pip stop, and then I adjusted the limit based on risk to reward ratio. So I did 50 pip stop with a 25 pip limit, 50 pip stop with a 50 pip limit, 50 pip stop with a 75 pip limit, and a 100 pip limit, and so on and so forth. And what I found out was, again, that the 1-to-2 risk reward ratio or better tended to do well. And the other thing I thought was like, all right, well, let me make this a bit tighter. Let me do a 25 pip stop. And when I did a 25 pip stop, the 1-to-2 risk to reward ratio, it just didn't work quite as well. And I think it didn't work quite as well because the trends at that smaller time frame are just not as strong as some of the trends that were on a 4-hour or a daily chart where you're looking for those longer moves. So I think that's one of those things that's very important that newer traders tend to overlook. Newer traders, they open up their account and they think, wow, I'm going to trade, I'm going to scalp, or I'm going to day trade. I'm going to set my risk at 15 pips. Well, just because you're setting your risk at 15 pips doesn't mean that's what the market is willing to breathe up and down for. And you just may be death by 1,000 cuts at 15 pips. So if you're doing a 1 to 10 risk reward ratio at 15 pips, it's probably not going to work out. Whereas if you see a strong trend developing on a longer time frame chart, and maybe you've got a 100 pip or a 200 pip stop, then you're more likely going to see a much better risk reward ratio on that longer time frame. And looks like Zabi's got a question here for you, Walker. Could you set up a trend on the pound using a 1 hour chart? So you just want to give us a quick analysis here with regards to the pound on the 1 hour chart, and A, identify the trend, B, would you trade it? Because if the trend's not obvious, then maybe we want to stay on the sidelines on that pair.
No, absolutely. The pound dollar been one of the strongest pairs that we've had, and as you'll see, we have a few markings here already from a previous look at the pound dollar, but it does fit our definition from a trend perspective. And what I'm going to do is just work from left to right here inside of the pound dollar and take a look at our highs and lows. And certainly over the period of the last 2 months, we have seen higher highs, even culminating in a breakout above our previous high, which was denoted here at the start of December at 64.40. Now, when it comes to entry and execution, certainly once you find the trend, you know that we want to look for an opportunity to buy if price is breaking out towards higher highs. So automatically, I'm presuming that I want to look for an opportunity for a price to go again and move up. We can go ahead and add our indicator as well and see if we have an overbought or oversold scenario. And we discussed both CCI and MACD and RSI in brief. Again, I'm just going back to our friendly default here. This is going to be CCI. And what I am firmly watching going to be this oversold variable underneath -100. Now, what that means to me as a trader is that over the course of the last several hours, we have had a sell-off in an uptrend. And what I want to do is see momentum return back to the pair, cross over -100, giving me an opportunity to buy. So if we're trend trading, again, that's the topic of discussion. First, we found the trend, which is up. Second, we can use a technical trigger, which is an oscillator, and look for a chance to buy towards a higher high. From there, all we have to do is mitigate risk. Again, if you want to keep your stops very low, you can see this previous line or low of support right here at 164.15. You'd be risking, again, if pips or if price went up in a few pips, you may be risking about 20 pips. And if you use a solid 1 to 4, 1 to 5 risk reward ratio, you may look for 100 pips or better. Just remember, if we are trend trading, and again we are, we want to look for a higher high, so our limits at a minimum should exceed our previous price right here in the neighborhood of 64.64. Great question.
Yeah, indeed. And, you know, since we have two different styles of entering into the trends, let me just share with you from a breakout perspective how we might approach that as well, Zabi. So here's the pound dollar 1 hour chart. I would agree wholeheartedly with Walker that I would be looking to buy. Of three different choices you have on a trade, to either buy, sell, or do nothing, selling is the third choice. That's the last thing I want to do on the pound dollar right now because it's in an uptrend. And the monetary policy out of England is bullish for the currency as well. So we want to look to buy or possibly do nothing if we're going through a bit of a retracement. So here's my Donchian channels on the 1 hour chart. So the setup is pretty simple. I just place an entry to buy 1 pip up above this high. And then that way, if it is a much deeper retracement, I would be kept out of a losing trade. And then my stop loss is going to be down here, which I know this seems like a long way away, but in the next few candles, once 55 candles has surpassed, you'll see this brown line start squeezing up higher. So time is on your side when you use Donchian channels, meaning when you enter into the trade, and let's say your risk when you initially enter the trade is, let's say, 150 pips. Well, it's not going to get any worse, and the longer you're in that trade, the tighter the stop loss becomes on the pound dollar. So I saw Artie had a question out here, and then Karen, we'll get to your question about the fractals here in a moment. Walker, Artie's asking about the dollar yen. Do you want to go ahead and make a comment with regards to Artie's question about the dollar yen?
You know, the dollar yen is one of those pairs that we think about when it comes to trending markets, and I'd actually encourage you already to check out Jeremy's analysis. He opened with a look at the dollar yen, the breakout that we had going back from our descending trend line starting here at the previous high. What I like about this is we are actually, again, let me flip out to a broader time frame here. We are actually challenging 2013 highs as we speak. Now, if you're using a breakout methodology, again, we want to see price clearly move above 103.82. And we're just about 100 pips off the mark. So in order for our definition for an uptrend to hold true, we need to see a continuation towards higher highs. But before those breakouts, again, we start to see this big red bar that's forming here on the dollar yen. Now, for me, this means that we may have the opportunity to go ahead and pick out a potential retracement on the pair. Now, here's a good example. Remember, in an uptrend, oscillators are going to stay overbought for extended periods of time. And we've been overbought now for over a month using CCI. Again, this is our quick oscillator. I want to see a retracement of some point to buy a dip, and we don't know how far or how deep that dip is going to go, but I want to look for one of these scenarios where we start to see momentum start turning back to the upside, and we had an excellent opportunity to buy into this uptrend prior to our breakout right here in the neighborhood of 97.23. So I want to see that set up again. If you're trading a retracement, this is one you're going to have to be a little bit patient on. Again, even if we're day trading, it's not action all the time. If we plan, we can wait, and then when the time's right, if we start to see the dollar yen decline, we can buy in at a better price. Conversely, and using Jeremy's methodology, we can look for a breakout over those 2013 highs.
Yeah, I agree wholeheartedly here. Artie, there is massive resistance up here at these highs. So the highs that we saw last week, let's see, the high of that candle was at 103.37. The high that we saw today was at 103.39. And if we go back to the high of 2013, that high is at 103.73. So we're about 40 pips below that high. That is significant resistance. And so there's a couple of things that I'm pulling out of this recent price action. Because this is significant resistance near the 103.50 area, if all it can muster is a 200 pip sell-off, then that means this is going to be a massive trend to the upside. Okay? If we break higher and follow through above this 103.75 area, and all it did was a 200 pip retracement off of the first rebound, then this is going to be a force to be reckoned with. Everybody's probably going to be talking about dollar yen in short order for 2014. So with that being said, because this is massive resistance at 103.75, I would expect that there's probably going to be some type of deeper retracement coming. And but that doesn't mean that this uptrend is over. Deeper retracement just means it's going to be an opportunity for you to get in at a much cheaper price, much lower price. Now, for the bullish levels to stay intact, last couple of weeks, I've been tweeting out about this 100 to 101.50 area as the first level of support. If that breaks, this 99 level would absolutely have to hold. So you're probably looking maybe in this 100 to 101 area is probably an area where it's going to find some support, maybe trade sideways a bit. So, but longer run, the trend is up. Set your sights, on dollar yen to the upside. It's just a matter of where you get in or where you get out of that trade. So let me burn through a couple of more questions here. Sash says, what is your setting on the Donchian channel? It's a 55 period setting. The only reason that it's a 55 period setting is that's a Fibonacci number. And as traders, we tend to get crazy about doing silly things like using a Fibonacci number as an input value for an indicator or an oscillator. Um, Also, thanks. The stop, this is with regards to that pound dollar a moment ago. Let me pull up that real quick. Yes, that would be about the 163 area is where that stop loss would be. My lower Donchian channel is actually down here near 62.91. So that is where the stop loss would be down here. Yeah, I think this is, Karen, your question, I think that's with regards to Donchian channels as well, or horizontal levels of support and resistance. And that's certainly one way to do it if you're using fractals as a means to manage an open trade. I think that is what you're probably going to find is a tighter stop loss. And so you're probably going to get stopped out quite a bit, but you could use your Donchian channel to get back into the trade. So let me add my fractal to the chart here. And a fractal is just going to put some up arrows and down arrows, the blue up arrows and the red down arrows. And so let's say if this was our uptrend, every time you get a new red arrow to the downside, so let's say I'm long this trade, what you could do is wherever that lower fractal is, that's where you would move your stop loss. So right here around the 163 would be where my stop loss is. And then you'll notice a little bit later my fractal formed up here. And eventually prices stopped out, which would have been where this upper fractal is. So that's a good way of doing it. Requires a little more effort to manage it. Depends on the time frame you're using, but that is also a good way.
Specifically for those that may not be familiar with fractals, if you don't mind me jumping in here, all it is a look at the pattern of candles on the chart, and it's very helpful for identifying these higher highs and lower lows. And if you see these blue points or peaks, all that means is this candle is sticking out and made a higher high relative to the two candles around it. Also, if we take a look at our red candles, all it's showing me is that we have a lower low, or again, one of those swing lows being developed at that area. And we can see right here where we had a low in price relative to the two blue candles on either side. And I believe Jeremy summed this up nicely. You'll notice that fractal's going to keep a much tighter stop, but it can be a great way to identify swing highs and swing lows. Great question, Karen. Absolutely love it.
Yeah, it was. And, one way to visually look at the fractal, Walker, your explanation was great. But when you take a look at your fingers, so you'll notice here, I'm right-handed, so let me use this hand. But you'll notice here my middle finger, I've got a smaller finger on the left side of it. I've got a smaller finger on the right side of the middle finger. So a fractal would print right up above the middle finger because it sticks out, like you said. And then if you turn it around in the element of a downtrend, you've got the lowest low of that three candle formation is where that fractal would form. So that's all it is. It doesn't really tell you anything about direction of the market. It just says that for that three candle period, it found a bottom. And in the next candle, it could start heading lower again. But it could be a useful place for placing a stop loss. Also, I want to take a moment here. We got a few more minutes left. If you have any additional questions, we can get into those. Sash, I see your question here. We'll have Walker answer that in just a moment. But I want to remind you that if you like this event, please go ahead and do a +1 on the page where you are watching us. You might have to back out of that Q&A area. But the video page where it tells you what time the event is and where the video is, if you +1 that area, let us know that you liked it. And also, if you have any additional topics that you would like for us to go over, we plan on expanding these types of hangouts moving into the new year in 2014. Certainly let us know in the comment area as well. So Walker, a question we've got here from Sash says, can we look at the euro, yen, and pound yen? Are these retracing? The euro yen and the pound yen, are those going through a retracement? How would you approach those?
Sure, great question. And we looked briefly at yen crosses again today, and I don't believe we've taken a look at the pound yen, so I've opted to choose this chart. Now, we can go back and we can continue scrolling depending on our time horizon, but one thing is certain: if we're walking down our charts, working from left to right, again for the 2013 trading year, we should see that we are indeed making higher highs. Now, a retracement, it's simply defined as a pullback from the trend, and this is going to bring us up to present price action. You'll notice that we made a new high. Again, this is going to be fresh highs all the way up above at 170.06. Now, price is trading at that high, so technically this could be a retracement. Now, is it going to be a full retracement? Is it going to be the end of the trend? These are all things that we're going to have to wait and see. But if we have a plan of action, and we've discussed the three-step trading plan, first, do we have the trend? The answer is yes. Two, if I'm trading a retracement, I can pull out my handy oscillator, and what we can do is just queue up CCI, again, using that as the default. I want to wait until this value gets oversold. And right now we're starting to see a pullback. We're seeing it moving from overbought. Again, that's showing our trend at least temporarily waning. And what I want to find myself is in a scenario where we have a crossover, where we start to see CCI turn back in the direction of the trend, allowing me to buy up towards higher highs. So are we in a retracement? We are indeed peeling off of the previous high. We haven't quite reached that oversold boundary. So if you're going from step 1 all the way to step 3 on our trading strategy, we'd want to pause at execution for now. We don't have that technical trigger, so this one going to be a wait and see. We have a deeper pullback. It may give us an opportunity to buy. Great question.
Awesome, awesome. Well, we have reached about the end here of our time in the webinar room, so we're about going on an hour here. So I just want to extend my hand to you all and thank you all very much for joining us here today. Walker and I will be back next week, same bat time, same bat channel. You know what, Walker, I'm thinking maybe we do what we perceive to be some of the bigger opportunities on the horizon for 2014 as far as trends go. Maybe we'll keep it light and brief, talk about a couple of trends that we might look for coming in the new year, at least in the first part of the new year, because of course neither Walker nor I have that magic 8-ball or crystal ball that knows exactly where prices are going, but perhaps based on some of the patterns or some of the trends, we could talk about what some trends we've got our eyes set on for the new year. So what do you think about that, Walker?
Oh, wow. That sounds fantastic. And I have to say, some of these trends that have been developing through 2013, they have a strong chance of continuation. So I can't wait to go ahead and bust out into the 2014 trading year. One thing's for certain: whether the trends shift or whether they continue, if we follow our three-step trending plan of action, we'll know how to approach the markets, first by identifying market direction, then timing our execution with either a retracement or a breakout, and then finally manage risk. And I know today we spent a lot of time on trend identification, but I think the third step is really what's going to be the major resolution of 2014 for most traders. If I could just say one thing, everyone should be resolved to utilize stops and contain their risk by using a stop loss in their trading. Jeremy, I have to say it's been my pleasure here again hosting this event with you. I want to thank everyone who joined us on behalf of Daily FX inside of Google+.
Yeah, thank you very much, Walker, and thank you everybody else. I agree with Walker. It's more than just entries. Too many times folks focus on the entries, but just like that monkey strategy that I shared with you earlier showed, it's how you manage trades can also be as important, if not more important. And if you can identify a strong trend, sometimes that strong trend can bail you out of a poor entry, and then you just use proper money management. So you just try to make it simple. And next week, what Walker and I will do is we'll bring some of these strong trends that we're considering, as continuing from where we're at today, and some levels to watch out for that would take us into 2014. So, but thank you all for being here, and we look forward to receiving your comments. We look forward to interacting with you through Google Plus as well. And until next week, have a great week. Be safe. Bye now.